That's about the global markets. Let's quickly talk about the Indian markets. Rohit Srivastava, the founder and strategist at IndiaCharts.com, is joining in on the show now. Rohit, morning, and thanks so much for joining in. First, your thoughts on the markets, the setup, where we're headed?
My sense is after what we have seen last week, the Nifty itself has peaked very close to the high that we made in April near 18,115. And the Bank Nifty got close to the high that we'd made in October of 2021, near 41,830. I think these two become a very important testing levels because both of them would amount to some type of a double top happening in the market. Bank Nifty at a bigger degree, and the Nifty, which has sort of made lower highs all the way from October to January to April, and now we have multiple highs which are lower, and that sort of keeps the larger trend in check, which is that despite we've had these strong rallies from time to time, the overall trend of the market has remained lower, except that we've seen different sectors participate at each point of time. But my sense is we are getting to the part of this crisis which has been linked to inflation and rising yields, where we might be in the final stages, where you actually get more of a broad-based corrective decline across sectors. And that is, I think, the risk in the weeks ahead, which is where we are sort of stepping back and taking a seriously cautious approach at this level in the market.
Okay, you're saying that you could see some sort of consolidation ahead, and probably, we also do have a big event this week, which is of the Fed meet. Rohit, good morning, and thanks a lot for joining us. Do you think in this setup there are pockets which seem, perhaps better positioned to do well at this time?
So the only pockets, and I would say when we say position to do well, if we are anticipating a possible, a downward trend in the market, is that what will relatively hold out. So the two sectors, I think, which can relatively hold out, maybe either by falling less, or if there are some gains, would probably be pharma and defense. Defense has, of course, been strong anyway, so it's easier to spot that as an outperforming sector. But pharma has actually been an underperformer because the pharma sector has been weakening even ahead of when the index peaked out. So it's been one of the poor performers post the very strong performance it gave in the year of the pandemic. After that, the pharma sector simply didn't do much. And I think that could end up providing some kind of surprise, if at all, because when markets do correct, sometimes money gets reallocated to defensive sectors, and pharma would be one of them that would really attract that kind of allocation. So I think that could be a surprise. So these would be the two sectors I would think of, in a potentially weak market.
How long do you think the markets could remain subdued or weak? You've put a target price of 16,700 over the medium term. How long will that medium term last? Because we have been in a time-wise correction for nearly a year now.
So one is the long term. So when we think of long term, typically bear markets in India have lasted anywhere between 15 and 21 months. So if you take it from the peak in October of 2021, 15 months would somewhere put us, close to Feb of 2023. So that would be sort of a timeline for a bigger picture to play out in terms of whatever downside risk might exist. Now, when I'm talking of 16,700, it's slightly more medium term. So we're not looking at the big picture, but looking at more the immediate scenario. After the selling that we saw on Friday, the first level of support is going to be at around 17,300. Now, if we do break that, we head to where the weekly averages are, and that's sort of in the 16,700, 16,800 range. So that's going to be the first testing support that we are going to look at. So those are more like levels we are looking at in a time horizon of maybe 3 to 4 weeks.
Rohit, we have been talking about this entire divergence from what's going on globally, but generally, if you take a look at it, it's normally not something that can sustain for a very long period of time, right? Do you think it's only a matter of time before we sort of do start reflecting the kind of hit that we are seeing in global markets as well?
I definitely think so. I'm not in the decoupling camp, having seen markets for long enough of a period. I think we've seen such deviations last for several weeks or several months even. We can go back to 2008, between October of 2007 and January of 2008. The Indian markets continued to make higher highs even as the US had actually rolled over. That's not the only example. I can even go back, to 2001, midway through that bear market after Y2K. The Indian markets diverged between October and February of 2000, 2001. And we continued to make higher highs even as the Nasdaq was making lower lows. So this does tend to happen. And many times the thought is that, well, Indian markets are in a better place and therefore, certain stocks start performing as value buying steps in. So I think we've seen a bit of that over the last, month or so. But eventually, I think the risk of, tightening liquidity conditions, which is the right word, I think, of what is really happening. So even if you keep all things equal, fundamentally, the macros of India, everything remains equal. Tightening liquidity conditions are the single most factor that sort of affect valuations. So valuations themselves get triggered to move to a lower level. And that is, I think, the risk that even India would face despite all the positives that are there. And so as long as we are moving into a tightening situation with multiple, as you mentioned, multiple central banks coming in over the week, and they're all the policies are moving in the same direction, markets are likely to contract and can't keep breaking away from what is looking like a global trend.
And the biggest impact has been on the IT sector. What does the risk reward now tell you for the technology sector after the kind of underperformance we've seen?
So the IT sector, in fact, is the closest mirror of what is happening in US equities and specifically the US tech sector. So it's moved very much in line, unlike the Nifty, which appears to outperform. Last week, the IT indexes, in fact, broken the previous low, exactly like the Nasdaq has also done during the last week. So if we expect further weakness, which we do in US markets, I think the IT sector would see most of the damage, and which is why, even though it's fallen so much and it may appear cheap to some, I think the maximum risk is still in the IT sector because it is so externally driven, and so we'd still continue to avoid it till we can see the black clouds really go away from what is happening in global equities.
All right, still avoid the IT sector, but what you're sounding slightly better on is the pharma space as well as some of the defense stocks. With that today, thank you very much.